Welcome to everyone. And just today we are going to discuss our accounting for receivable sectors and describe how companies value account receivables and record their dispositions. Very important discussion today. This is learning objectives. We have 4 objectives. Already we have discussed one, and today we will discuss objective 2. Learning objective 2. Describe how companies value accounts receivable and record their disposition. Very important discussion today, and I think this discussion will longer, and everybody will enjoy this discussion. And the name of the chapter is accounting for receivables. And here valuing account receivable and uncollectible account receivable. Valuing account receivable, it related to current assets, and valuation, and this cash realizable value, cash realizable value. Okay, so here uncollectible account receivable, sale on account raise the possibility of accounts not being collected. Number one. Number second, companies record credit losses as debits to bad debts expenses. Later we will discuss more on this topic. Alternative terminology, you will sometimes see bad debt expense, sometimes called uncollectible accounts expense. Okay, move to next. Methods of accounting for uncollectible accounts. Just here two methods, write off methods, direct write off methods, allowance method. Basic difference: theoretical under undesirable, no messing, receivable not stated at cash realizable value are not acceptable for financial reporting. Our allowance method, better messing. Here not messing, please look here, not messing, but here better messing. And here receivable not stated, but here stated at cash realizable value, and not acceptable for financial reporting, but here required by GAAP, generally accepted accounting principle. Okay, so valuing account receivable, how are these accounts presented on the balance sheet? So here look everyone, account receivable, this is the beginning balance $500 and ending balance $500. Allowance for doubtful accounts, say beginning balance 25 and ending balance 25. Ending balance means just this is the collective amount. So here according our balance sheet, that means this is our partial balance sheet, and this is the current asset side. That means current asset includes cash, account receivable, inventory, prepaid expenses, and total current asset. So this point is very important, this point. That means account receivable $500 and less allowance for doubtful accounts 25. Next, here the same matter, account receivable, total here 475, and this is the 475 account receivable, net of 25% allowance, 475. Journal entry of credit sales $100. Journal entry very easy. Credit sales, we know account receivable will be debit and sales will be credit. This is very general journal. And account receivable, beginning balance 500, ending 500. That means this balance. And allowance for doubtful accounts 25 beginning, and this is the ending also 25. And this 100, we will see later on how can we show in the various step. So here accounts receivable, here beginning balance 500, and then this account receivable sales 100. That means total 600, and here 25 allowance for doubtful accounts. Now collected 333, that means 333. So cash will be debit and account receivable will be credit. So according to our calculation, just this is the total 600 minus collected amount 333. That means account receivable 333 collected. That means this collected amounts 333, this amount. So after balancing we are getting this figure. That means this is the ending figure $267. And allowance for doubtful accounts the same 25. Now bad debt expense, that means $15 estimated for bad debts. So bad debt expense will be debit and allowance for doubtful accounts will be credit. So here this will be the actually this 15 estimated balance. So here total allowance for doubtful accounts will be 25 and 15 to 40. Okay, and this side account receivable the same. And now write off this 10 taka write off. So when we write off this 10 taka, that means the write off 10 taka account receivable will be credit. That means this is the credit side, and here allowance for doubtful accounts debit, this is the debit side. So after balancing we are getting 30 and we are getting 275. And this is account receivable 227. That means 227 minus 30. That means 227 minus 30. 227 minus 30, 227. And this is the 227. Okay, I think everybody is clear. Now direct write-off method for uncollectible accounts. A very easy example, everybody please look here. Illustration. Assume that Warden Company writes off Amy Doran's $200 balance as uncollectible on December 12. Warden's entry is entry will be Warden, that means bad debt expense debit and account receivable credit. Amy Doran. That means here the assume that Warden Company writes off Amy Doran's 200 balances and uncollectible. That means Warden Company here seller and Doran purchaser. So he has failed to paid $200 suppose, and this could be write off now, and this will be bad debt expense debit and account receivable Doran book. That means 200. Okay, and here theoretical undesirable, just earlier we discussed this matter, not missing and not stated and not acceptable for financial reporting. Okay, this method, that means bad debt expense or accounts receivable. Allowance method for uncollectible accounts, just very easy to understand. This estimated and debit bad debt expense or credit allowance for doubtful accounts, or debit allowance for doubtful accounts and credit account receivable at a time of specific accounts write off. Okay, just later on we will discuss more on this matter. Recording estimated uncollectible. Suppose the Hampson furniture has credit sales 12 lakh. 12 lakh. So in 2017, on which 2 lakh remains uncollectible at December 31st. The credit manager estimates that $12,000 of these sales will prove uncollectible. That means from here three matter: credit sales 12 lakh, remains uncollectible 2 lakh, and from this 2 lakh the credit manager just thinking that the 12,000 amount will not be collected. This could be or will prove uncollectible. So for this our transaction will be bad debt expense debit, this 12 lakh, and the allowance for doubtful accounts 12 lakh. Okay, so here this could be the balance sheet partial current asset, that means cash. Here please look, cash, this amount, this is imported account receivable and allowance for doubtful accounts. So 1,88,000. So the amount 1,88,000 represent the expected cash realizable value. expected cash realizable value, this amount, okay, of the accounts receivable at the statement date. And now, very important and interesting matter, the Vice President of Finance of Hampson Furniture on March 1, 2018 authorizes a write-off 500 balance owed by a air wire. The entry record the write-off is. That means allowance for doubtful accounts debit and account receivable credit. And here this is the ledger balance 2 lakh and this 500 account receivable credit, that means this amount, that means this amount, okay. And the March 1 balance $1,99,500 and allowance for doubtful accounts 500, that means this uncollectible was 12,000 and now 500, that means this is the write-off. So March 1 balance $11,500. Now recovery and uncollectible accounts recovery, very interesting matter. That means previous 500 dollar, that means on July 1, that means this figure, this figure, that means this 500 which we written down or written off just July 1 we have collected this amount again. So for July 1, thus first one we will be vice versa journal, that means this journal will be vice versa, that means account receivable debit and allowance for doubtful accounts will be credit, okay. So this is the journal, accounts receivable debit and allowance for doubtful accounts credit, and for this collection, that means 500 taka cash will be debit and account receivable will be credit. This is the actual journal, and this journal written off and again vice versa for collection this amount. That means the customer RA wire pays 500. RA wire, just previously we have seen that RA wire, just this amount wire was written off and now we have collected this amount, and for this collecting amount just the two journal will be made. Number one, July 1, this is the vice versa journal and this is the actual journal. I think everybody is clear. Now percentage of sale and percentage of receivable, matching sale with bad debt expense and account receivable with allowance for doubtful accounts. Very important here, this is the income statement relationship, this is the balance sheet relationship, okay. I think everybody is clear. Percentage of sale matching sale bad debt expense, already we have told this matter. Now very important matter, another that means collects use the percentage of sale basis, that means the total credit sales 8 lakh and 1% net credit sale will become uncollectible. So for this $8,000 will be debit bad debt expense and allowance for doubtful accounts credit $8,000. Now emphasis matching of expense with revenues, adjusting entry to record bad debt degrades the existing balance in allowance for doubtful accounts. That means bad debt expense December 8,000 and allowance 8,000. So total balance 1,723 balance, and now the new balance will be $9,723. Estimating the allowance, a percentage of receivable, cash realizable value, account receivable and allowance for doubtful accounts, and this is the balance sheet relationship, okay. So here please look here, aging the account receivable, that means customer 1, 2, 3, 4, 5, this 5 customer total credit sale, these figures, and not due, these figures, and on this figure estimated percentage uncollectible 2%, just estimated 2%. Real 1 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days. So total uncollectible account amounts, just we have impose percentage 4, 10, 20 and 40, and after calculating just we are getting this figure, this figure, this figure, this figure and this figure, and total estimated bad debts 2,228. Very interesting matter here. Assume that unadjusted trial balance shows allowance for doubtful accounts with a credit balance, this figure. Prepare the adjusting entries, assume this figure, that's why previous we have got it. 2228 estimated uncollectible receivable from the aging schedule. That means already credit balance this, and this is the unadjusted, and this is we need to be adjusting. After adjusting, we are getting here this figure. That's so very important matter. After deducting this figure to this figure, we are getting this figure, $1,700. So bad debt expenses, allowance for doubtful accounts. Okay, and this is the bad debt expenses adjusted, and allowance for doubtful balance this one, that means this one balance, and this one. Now after adjusting, we are getting the balance 2228. Okay, companies sell receivables for two major reasons. Receivable may be the only reasonable source of cash. Sometimes the company sell the receivables because of to collect cash. That means only reasonable source of cash. Billing and collection are the time consuming and costly. The so sale of receivable, finance company or bank, we can sell to them, buy the receivable from business and then collects the payments directly from the customers. Typically charge the commission to the company that is selling the receivables. Fee ranges from 1 to 3% of the receivable purchased. Okay, so here this is very important matter. This is the 6 lakh dollar. Assume the hard Hender done furniture factors. These figures of receivables to federal factors. So from federal factors, we are getting some amount. The federal factors services 2%. Okay. So cash we are getting these figures, and this $12,000. This is the services expense and the account receivable. We are losing this account receivable. We are getting cash and services. Okay. So credit card sale. Credit card sale actually record the same as cash sales. Retailer pays credit issuer a fee 2 to 6% of processing the transactions. So Anita Ferrari purchased $1,000 of compact discs for her restaurant from Care Music Company using the Visa First bank card. First bank charge to service fee 3%. The entry to record this transaction by current car music is as follows: cash this figure, that means 1,000, 3% fee. So this is the service charge 30, and this is a $1,000 sales revenue. Okay, do it. Borul company has been a business 5 years. The ledger at the end of the current year shows account receivable debit, sales revenue credit, allowance for doubtful debit. So bad debts are estimated 10% of receivable. Prepare the entry to the adjusting allowance for doubtful debts. So bad debts expense debit and allowance for doubtful credit. That means 30,000 account receivable 30,000, and this is the 10%. So 30,000 10%, $3,000 plus this $2,000, so total $5,000. Okay, thank you so much everybody for joining with us. I think everybody